You know, if you're trying to follow the Toronto real estate market right now, your head is probably spinning. One headline screams that prices are in a free fall, and the very next one predicts this massive rebound is just around the corner. It's a mess of confusing, contradictory signals. So we're going to cut through all that noise. We're going to connect the dots between a historic sales slump, a shifting rental market, and the deep-seated issues that got us here to build one clear story of Toronto's housing market at a crossroads.
So here's how we're going to break it down. First, we'll look at the hard numbers behind the current market freeze. Then, we'll pivot to the really surprising story that's unfolding in the rental world. From there, we're going to dig into the psychology of buyers and sellers, uncover the hidden costs that keep prices so high, and then finally, look at the competing forecasts for what might be coming next. All right, let's dive right in. We have to start with the hard numbers that define what's happening in the Greater Toronto Area's housing market. And honestly, the data paints a picture of a market that isn't just cool, it's pretty much frozen solid. To really get your head around the scale of this slowdown, just think about this number, 25 years. You have to go back a full quarter of a century, all the way to the year 2000, to find a time when fewer homes were sold across the GTA. I mean, this isn't some minor dip, it's a historic pause in activity. It takes us back to a level of quiet we haven't seen since before those decade-long booms that really defined modern Toronto real estate. So at first glance, this table looks like a pretty typical slowdown, right? Total sales dropped by over 11% and the average price fell by almost 5%. But there's a fascinating tension hiding in these numbers. Look at the new listings. The number of homes hitting the market for sale, that number actually went up by over 10%. And that is a crucial dynamic. It means fewer people are buying, but more people are trying to sell. This imbalance is what's shifting the power from sellers to buyers for the first time in a very, very long time. So really, the story boils down to these two key things. First, you've got this significant plunge in the number of deals actually getting done. That's the 11.2% drop in sales. And second, you've got a more moderate, but still pretty significant, decline in the average price tag. This combination of fewer sales and lower prices, that's what defines the cooldown. Okay, so let's switch gears and look at the other side of the housing equation. Because while the ownership market has been freezing over, the rental market, well, it is telling a completely different and frankly pretty surprising story. After years of relentless price hikes and crazy competition, a major shift is underway. You know that narrative we all got used to, bidding wars for basement apartments, record high rents every month? Well, that has been completely flipped on its head. In 2025, we saw the sharpest drop in asking rents in over 4 years. For the first time in a long while, tenants are actually finding some breathing room as demand cools and prices correct.
And this really gets to the heart of why the rental market is cooling so suddenly. The theory is that the huge price surge wasn't just about local demand. It was a kind of price contagion. The absolute frenzy in places like Toronto and Vancouver made everywhere else look cheap by comparison, so people started chasing that affordability, which in turn pushed up prices in all those secondary markets. Now that the frenzy is over, the market is correcting, and that affordability gap is starting to narrow once again.
And this sales slowdown is directly reshaping our future housing supply. Think about it. With condo pre-sales drying up, developers can't get the financing they need to build. So what's their response? A massive pivot. They are converting planned condo projects into purpose-built rental buildings. This is a fundamental change, shifting the entire pipeline from creating homes for ownership to creating homes for rent. And this pivot has real-world financial consequences. You see, when a developer builds a condo, their main risk is getting it sold. But when they build a rental, their risk is about collecting rent, month after month. This introduces a whole new set of challenges, and it requires specialized insurance products, like this one, delayed startup coverage. Basically, this policy protects the building's owner from lost rental income if something delays the grand opening. It might seem like a small detail, but it shows just how deep the structural shift from an ownership market to a rental market is really becoming. So we've looked at the hard data for both sales and rentals. Now let's explore the human element. Because behind every single one of those statistics is a person, a buyer, a seller, a renter, trying to make a huge life decision in a time of profound uncertainty. So what are they thinking? And what's holding them back? Well, despite all the doom and gloom, the dream of home ownership is far from dead. This survey shows that a full 25% of millennials, that's Canada's largest demographic, say they will probably buy a home in the coming year. That is a surprisingly resilient number. It tells us that there is a huge well of pent-up demand just waiting on the sideline. Which brings us to the central puzzle of the current market. We have a historic number of listings, giving buyers more choice than they've had in years. We have prices that have softened from their peak, and we have this massive group of potential buyers who say they want to get into the market. So what's the disconnect? Why are sales at a 25-year low? Well, the answer is a crisis of confidence. Over half of prospective buyers say they're being held back by uncertainty around home prices. They're terrified of buying today only to see the value drop tomorrow. Nearly a third are waiting to see what happens with interest rates, while another third just point to general financial uncertainty and worries about their jobs. So it's not a lack of desire holding the market back, it's a profound sense of anxiety about the future of the economy. All right, now let's peel back another layer of this onion. We need to dig into one of the most significant, yet often overlooked reasons why housing is still so expensive to build, even when the market is down. This goes way beyond buyer sentiment and interest rates into the fundamental costs that are baked into a new home before a single shovel ever hits the ground. Just take a look at this number, 592%. Between 2011 and 2023, the development charges, these are the fees that cities charge on new construction to pay for stuff like roads and sewers, for a single detached home in Toronto increased by that much. These government-imposed fees have just dramatically outpaced inflation, and they've become a massive driver of new home costs. We're talking about adding six-figure sums to the price of a home before construction even begins. And what this has created is a dangerous feedback loop. It starts like this: cities need money for infrastructure, so they raise fees on new homes. But then, those higher fees make new homes more expensive and harder to build. As projects get delayed or canceled, the city collects way less revenue than it expected, which forces it to raise the fees again on the few projects that are left. So the very tool that was supposed to pay for growth ends up stalling growth and making the housing crisis even worse. And this problem is only made more complicated by friction between different levels of government. So while the city is raising fees to try and fund infrastructure, the federal government is actually cutting funding because of disagreements on zoning policy. It's this political tug-of-war, and it leaves builders and buyers completely stuck in the middle. So after looking at the sales slump, the rental shift, buyer anxiety, and the structural costs of building, where does the Toronto market go from here? Well, all this data has led us to a genuine fork in the road, with credible experts making really compelling arguments for two very, very different futures. On one side, you have the optimist case. It argues that years of pent-up demand are just waiting for a green light to jump back in, interest rates have stabilized, and the underlying inventory is still pretty low. They see a market that's poised for a big spring rebound. But then on the other side is the pessimist case. They point to rising unemployment, the financial strain of millions of mortgages renewing at higher rates, and disruptions to the investor market as reasons to expect even more price declines. Both arguments have merit, which is exactly why the path forward is so uncertain. So let's pull all this together. We're in a historic pause not seen in a generation, and it's opened up a rare buyer-friendly window, even providing some relief for renters. But a huge confidence gap driven by economic anxiety is keeping an entire generation of buyers on the sidelines. And underneath it all, the fundamental cost of building new homes remains painfully high. All of this puts the Toronto market at a genuine fork in the road, making the year ahead one of the most unpredictable in recent memory. And this leaves us with the ultimate question. Is what we're experiencing just a temporary correction, a brief pause before the market just resumes its upward climb, or is this the beginning of a new normal, a fundamental reset of our expectations around price, affordability, and growth in Toronto real estate? The answer to that is going to define the housing landscape for years to come.